what really I think matters here is the credibility of macroeconomic policy. So South Africa and many other emerging markets now run inflation targets as their monetary policy frameworks. And these are really important because what you need to prevent happening in the case of depreciation is the risk that you get inflation spirals. So you've got capital coming in. There is a need for some kind of currency depreciation to offset the size of your current account deficit. What you don't want is an inflation spiral to emerge, and you don't want capital to flow out in response to that, exacerbating the depreciation and driving inflation up much higher. And the way to deal with that most effectively is to have this very credible inflation target that limits the pass-through from currency depreciation to inflation, and keeps capital flows from exiting the economy. Or if they do exit, they come back in relatively quickly. So that higher credibility reduces the extent to which adjustments to exchange rates or imported price shocks pass through to domestic inflation. It also reduces the temptation for central banks to use foreign exchange intervention to help minimize currency movements and their effects on prices. And I talked quite a bit about this in the South African context, about how efforts to do that by the central bank in previous episodes of currency outflows and depreciation generated very adverse effects.